Hey everyone, Happy New Year. Happy 2024. I think there's a lot to look forward to this year. There's obviously a lot, of geopolitical concerns. There's a lot of stuff happening in the world that could really upset the growth profile. Um, when it comes to markets, inflation obviously and growth are the two big drivers of returns for investors and the intersection of those two. As Ray Dalio says in his very famous videos out there, and if you haven't seen them, you should, how the economic engine works. The intersection of growth and inflation really, at the bottom line, when you think about it, it's earnings. So those two aspects are going to be front and center. The geopolitical politics are back here, but they have the ability to really come up here very quickly, as we've seen with the Houthi rebels and the attacks in the Red Sea, and what's that doing to shipping rates and perception of oil demand and supply and etc. Saw some narratives this week on Russia wanting to cut supply to push prices up so that Biden has a higher chance of losing the election, or the Democrats, and they get a more favorable U.S. government to Russia. I don't think that's really possible. I don't think any government is going to be favorable to Russia. Maybe Donald Trump, who knows? But I think it's politically impossible to bring Russia back into the world at this point. I think they've isolated themselves somewhat permanently, at least until Putin's out of the picture. Anyways, let's dig into the chart room and see what we learned this week. No, it's all about the rate hikes and what's priced in. So as we started the year, we look at the SOFR futures for December and where they're trading at, and you get a sense of how much is priced in terms of rate cuts. And the narrative that we're seeing out of the Fed minutes that hit this week, everything is trying, I think, to push those rate hikes back, or sorry, rate cuts, push those rate cuts back. So higher for longer remains the message. So when the headlines hit for non-farm payrolls, and the headline came out a little bit more, SOFR futures initially sold off 10, 12 basis points, so half a move. Again, when the price of SOFR futures goes down, you subtract 100 from 95, and that's your interest rate. So, that would imply less rate cuts. At 10 o'clock, you had the ISM numbers come in on the soft side, and boom, price go up, more rate cuts. So at the end of the day, you look at it and it's really unchanged from the previous day, a basis point and a half difference. When you look at the Bloomberg terminal, they've got this function that says, based on where we are now and the futures curve, or the OIS curve, overnight interest rate swap curve. There's two ways of looking at it. They're both tied together and very similar. 5.5 rate cuts are priced in, and if you bring it out to January next year, it's 6. And to me, that's just outrageous. In order to get that, we need inflation to fall perfectly. And what we are seeing with inflation is that the cyclical inflation, the commodity stuff linked to commodities, food, energy, again, make no mistake, it's a big part of what everybody's consumption is, have come down significantly. Geopolitics probably risk that to the upside looking forward, but that's another story for another day. And then when we look at the other components being rents, obviously, that's going to slow down. But the demographic dynamics and the immigration dynamics are such that rents, cost of building and everything else, we have a supply-demand imbalance. And I think rents are ultimately going to come in higher going forward. So When you look at sticky inflation, those are the prices that don't change day to day, week to week, like the commodity cyclically linked ones. So think, tuitions for school, think sports ticket prices, think, I don't know, things that have longer insurance costs, those kind of things. They don't change by the day typically. So that sticky inflation is running still much higher. The wage components are still much higher. The labor market still, even though it's loosening, we're still at full employment by the way the governments measure things. It's a little bit worse, maybe a lot worse in Canada than it is in the US from that perspective. But nevertheless, inflation's going to be stickier. So I don't think we're even going to come close to this. The Fed is probably a bit closer to what is likely going to happen a year from now, meaning maybe 50 basis points, maybe 75. I would not be surprised if it was less than that. So we'll see. But again, we saw in today's employment number, businesses are reluctant. They're not hiring as much as aggressively, but they've been reluctant to fire workers. And until we actually see those layoffs, we're just going to see the economy keep doing okay, which means these rate cuts aren't coming. And then when they come, it's eventually back, and it's when the economy is turning down, which is bad for earnings. So the market, to me, is completely mispriced here. You had this massive rally. It started around the QRA. So on 31st of October, we get the announcement that there's a lot more debt coming. And then 2 days later, we get the Fed meeting and the components of that. And Janet Yellen chose to fund it with bills, got sucked up by the excess reserve market in repo, and we had a massive risk-on rally. Yields came down. So now at 4, the risk returns are not nearly attractive. I mean, my buddy Rosie says we're going a whole lot lower as others are. And I don't believe that, because the supply and demand dynamics of deficits and QT, to me, make the risk reward of being long duration at 4 completely different than at 5, if you're in the stickier inflation camp. But if you are in the inflation camp where it's going to be low and the Fed is going to be easing aggressively, and they don't need to care if we're at full employment, then you can argue probably correctly that there's more to come on the downside. I don't believe that's the case. I don't think we're going to see bond yields move north of 5 again in the 10 and the 30. We're looking at the 30-year here. But I do see us coming back as bond supply comes and more coupons need to be financed, that we get above 4.5 to 5, somewhere in that range. Impossible to say where, but higher is probably likely, with some of those rate cuts that we saw priced in start to get priced out or pushed back, more correctly put. So what does that all mean? Well, as we know, the leadership's been the NASDAQ and big tech and the Mag 7 and everything like that. And so, we had come up to the November FOMC. There was expectations, higher for longer, and the Fed does their pivot dance. And so that ignited animal spirits. Again, we talked about the QRA and the funding, and we get this risk-on rally. And then we get the official pivot and move towards, now they're talking about cutting rates at the December FOMC, which is here. And ever since that, sell the news kind of thing, we're seeing the leadership struggle. Okay, so important messaging here. If we start getting back below these old highs from where the Qs broke out, that would be the first sign of weakness. If we get back to where this rally was ignited and it doesn't hold and these lows break, that to me would be confirmation of a hard economic landing and the higher for longer rate message. How does that play out? I don't know at this point, but I can't for the life of me figure out why I want to be super long equity risk at this point, or bond risk for that matter. So again, feeling kind of silly. We did tell you that this was a turning point and we were likely going to see a retest of the highs or come close. We've exceeded them, but this is not a time to think this is a sustainable breakout in my mind and in my view of the world at this point. When we look at market breadth, we always look at how many stocks are participating. And one of the best ways to look at that is an equal weight index versus a market cap weight index. And we know the big cap tech names have done all the lifting or most of the lifting in markets until very recently. So this is a 5-year look at the MSCI World Equal Weight World Index and the market cap weighted world index. And you can see significantly 4.16% average annual excess returns from the market cap weighted, meaning the average stock isn't doing as well, but it's still 8% a year over the last 5 years. So let's change this time frame a little bit and let's look at the last year. And again, you can see that the most of the lifting was done by the large cap market cap weighted for most of the year. They started off the year. We had the problem in banking here, and then the divergence happened where the Fed had to pump the liquidity with these programs, and then that caused the big tech to take off here. Let's bring it down a notch and look at the last 6 months and say, okay, well, really, go back to the last year for a second. Really, in the last 6 months, since these highs, breadth has improved significantly. And in the last 3 months, and more specifically in the last 2 months, and since the QRA FOMC in November, the equal weight, the average stock has done better because financial conditions started to ease significantly with lower rates and everything else. So that's a good thing. Market breadth is improved, but we lack, I think, the catalyst for the follow through now, unless the narrative on the Goldilocks outcome plays out. And I'm not in that camp at the moment. So pardon me for being a little bit skeptical on the rally here. If you're a pure technical guy, you say breadth is improving and everything else. And I just always ask that question. Okay, I'm seeing this in the charts. It's probably what it means, but is it likely? Because oftentimes the market gets irrationally exuberant, and I think we're in one of those periods now where it's just pricing in this Goldilocks outcome that seems less likely with every little data point that we seem to get. Anyways, Happy New Year, everybody. Go Bills, go. Dolphins are going down this weekend. Have a great one.